So welcome everybody to today's webinar on employee benefits. We're going to be looking at what employees actually want and how to avoid the pitfalls. We're going to cover today, why we offer employee benefits, what's popular by sector and age group, what benefits we should be offering and how we can effectively communicate those to employees, what's trending at the moment, and really importantly, what to watch out for. So I'm thrilled to be joined by Gareth Carroll, who's an Associate Director at Beckett Financial Services. He's been in the industry, he says, nearly 20 years and manages a large client bank ranging from blue chip companies to smaller local family-run firms. So he's got really broad experience. Today's session is going to be recorded like usual, and I'll send it out to you in the next few days. So please feel free to ask questions as we're going along using the chat box. And then we've got time for a live Q&A with Gareth at the end. So if there are any questions, feel free to send them across to us. So no further ado, I'll pass.
That's great. Thank you, Eloise. So it's nearly 20 years. It's 19 years. It's 20 years in June this year. I know you were going to say it doesn't look old enough. As
I was going to say,
but then you've obviously taken a look at me and thought, no, actually, 20 years seems about right. So
no, not at all. You don't look old enough.
Thank you very much. So this afternoon, in talking to Vanilla and Eloise, I thought I volunteered myself as a speaker to come on and talk to you guys. I've heard about the HRHuddle for years because our office is up the road in Kibworth, and I know some of your HRHuddle members, and I've always thought, blimey, if there's sort of 60 or 80 HR people in a room, that's like a room that I need to be in, because most of my clients are HR contacts. That's mainly who we deal with. And I thought that's just where I need to be. You've got to give something to get in. So I volunteered to do a webinar. I've done a webinar before. I've done presentations to staff. So it's a kind of a bit like that.
Today we'll be gentle with you, so don't worry.
Thank you very much. So today it's on employee benefits. Employee benefits is an absolutely massive subject, and as I'm talking to nearly 90 HR people, you probably know more about some parts of HR than I do. The bit that I'm qualified to speak on is sort of group protection, because that's anything that you might want to purchase for your staff, you can purchase it via us. We advise and manage it. So that's what, and I've been doing that for 20 years. So I'm quite well versed on that side of things. Flexible working and all the regulations and the things that you guys have to do. Please don't ask me a question on that at the end. So I've tried to organise my thoughts into why you might want employee benefits. Because some people do say, well, we don't really do that. We just pay people, So why you would want to look at employee benefits, what you need to think about when you are sort of looking at putting your package together, how you should be communicating that, because that is the most important thing you can do. And then as I was going through, I was thinking, I should really tell people about this. I should really tell people about that. So sort of towards the end, it's kind of like my top tips. So I'll kind of it's the kind of things that I would use to basically to pick up new business. When I go in and sit with a new HR contact, it's the things that I think I must tell them that to impress them. So here you all are, and I am. So I'll start off with a slide. Like most people working from home, I don't have a printer. So, and my notes, I did them all on Word. And so when I share my screen, I can't see my notes. And I tried to work out how to flick my screens around, and I can't remember how to do that. So this afternoon, I will probably be sticking a slide up, talking for a bit, and then taking it down. Because although I know what I'm talking about, I've got a terrible memory, and I don't want to forget something that, as I was making my notes, I thought, I'm not sure to tell them that. So I always talk like this. I'm really right. So share screen. Thank you, Angela. And I'll try not to get distracted with the chat.
Ignore the chat, Gareth. I'll do the chat. Don't worry.
Great. So if I go on to, I need to get my box I need to get my box away from there. Slideshow. There we go. So employee benefits, Gareth Carroll, and it's today. And then my next slide. So I thought that I would start off with this to sort of set the scene. So employee value proposition, EVPs. So a lot of you have been in the HR world, you'll be really familiar with this and you'll be thinking, oh, goodness me, this is a bit basic, but I thought it was a good place to start. So employee benefits is just one part of an EVP. So an employee value proposition, this is where my notes are good because I put down a definition. It's kind of like that's everything that you get. It's the entire experience of working for an employer. So it's obviously the salary. It's also the benefits, so pensions and life and everything else that you get with that. It's training, it's career advancement. It's what the work environment's like. I mean, is it a flash swanky office? You know, do you serve breakfast and give fruit? You know, but it's also the culture. And I mean, increasingly in the world that we live in, that is becoming very important. It's not just enough to offer somebody a job and expect them to come and work for you. They might sort of say, and is your pension scheme signed up to the Make My Money Matter campaign? You know, do you have economic, social governance, you know, on your pension scheme? They might want to know what your green credentials are, you know. So how you go about your business, how you treat your staff is a whole part of your EVP. It isn't any longer just what you pay and just the benefits that you offer. It's the whole thing. So we've got an EVP at Beckett's, which is like now on our website, and it goes through the whole staff experience, what it's like, who we are at Beckett's, how we treat our staff, how we treat our customers, the Beckett community, as we've started to refer to our customers. They're not clients any longer. It's our community, and it's how we look after them. So that is your EVP, and benefits is just one sort of part of that. So that's really where I could do to see my notes. So just to see what I forgot to say there. Stop share. I mean, I guess for some companies that might be tuning into this, you think, yeah, we know all about EVPs. We've had one for years. I was reading some research with Aon in the build up for doing this. They go out to thousands of clients every year and do a survey, and they're very much finding. I mean, although they are looking at more of the larger employers, they are finding that more and more companies are adopting an EVP now. Of their study, I think they had a third that were adopting an EVP, and another third that sort of said, we're working on an EVP at the moment, and we're going to have that in the next couple of years. Yeah, so it's flexible working, holiday progression, maternity conditions, you know, and shared paternity. It's all of these things that make up your EVP. And to kind of caveat what we'll be talking about today, whilst employee benefits is all of this, the bit that we will be sort of talking about today is the bit that I'm kind of qualified to speak to you about, which is the benefits part of that. Sounding okay, all right, Eloise?
Yep. Still fine.
That's making sense. Good.
Yep.
Right, I will go back onto share and stick this back up. Move my box and get it back on slideshow. Come on, slideshow. Excellent. Right. So, did somebody want to say something?
No, it's right.
Right. So, why offer employee benefits? Our lot just want cash. Now, I do hear this all the time when we're sort of talking about benefits or looking to put in a new spend with a company. You know, you would sort of say you know, life cover, it's going to cost you sort of £10,000. You know, it's around sort of 250 quid a head or something like that. And somebody will sit there and say, well, I'll not just want cash. You know, they'll just want the 250 quid. And yeah, we hear that absolutely all the time. Of course, it's not always the most intelligent option, and this is really where communication comes in. You need to say to people, yeah, we could give you 250 quid, but let's face it, the pay rise is soon forgotten. And if you give a pay rise, another pay rise is expected at the you know, at a similar time the following year. You know, was that a salary review? So, and the cash, sorry, buying benefits for your staff is going to get them a lot more than just the cash. So, if you give cash, cash is taxable. So, if you give somebody 200 quid, they're going to get taxed. So, they're only going to get 160 quid. And then if they wanted to buy life cover, they'd be buying it out of net pay. So, and life cover is something that, as an example, is something that they need, they should have. If it's not been provided by the company, it should be something that they're buying. So buying it as an employer, they would also get more, because if you went down to the bank and said, you know, I want a life cover policy, you know, I want like 2 or 3 times my salary, the bank might say, well, okay, that's going to be 500 quid. So would you rather have the 160 quid, which is the you know, the 200 after the tax, or would you rather have the policy that is worth £500 to you if you were to buy it yourself? So let's go through these. So there are benefits to both employer and employee to having benefits. So to the employer, to the employee, sorry, they receive the thing that they are being given, thus saving on something that they otherwise would have paid themselves, and potentially they would have paid more for it if they bought it themselves. So, and that thing that you are giving them might not be available to buy privately. So in the case of life cover, or to be honest, any protection insurance, you're probably not going to be able to get covered a pre-existing condition. So in my example, if somebody does want 2 or 3 times their salary and they go down to the bank will say, fill out this application form, or, you know, call this underwriting number and tell us about your medical history. Now, if that person has had a heart attack in the past, they're not going to get the cover. Or if they've had cancer. With any sort of group protection insurance, if you buy it as an individual, you will pay a much higher price than you would have paid, you know, than the company would pay. But also, you're not going to get any pre-existing conditions covered. I mean, another example would be a pension. You know, you're far better to invest in a workplace pension scheme, because a workplace pension scheme is going to have a very, very low annual management charge. I mean, if you're thinking, I'm just going to do a SIP myself and I'll manage it all myself, you might pay 1% management charge. Whereas if you do that via your company, depending on your company, you could get an AMC of 0.25%, and potentially also more funds to invest in. So the product that you get as a group is usually superior to what you can get as an individual. And of course, the having the thing, you're buying people things for a reason, and that is to improve their well-being and their work-life balance. So if you give somebody flexible working, that's great. You know, that can help them with childcare, that can, you know, school runs and what have you. If you give them medical insurance, that might mean they're not waiting so long to get things fixed on the NHS, and they might get things fixed that they otherwise wouldn't have done because the NHS isn't going to pick it up potentially. All of the things that we give as benefits are there to sort of improve our employees' well-being. I mean, we at Beckett's, we put in some mental health awareness training, which we now do every year. I did that a couple of years ago, and that was actually a bit of a game changer for me. I'd never really sort of thought about mental health before, but the training that we were sort of given, it's quite a long course. You now recognise signs. You now start to think, I'm a bit run down. I've not been sleeping too well. I've got a lot of work on at the moment, and you start to notice the sort of changes in your behaviour, like markers, and it's kind of just sort of helped me manage my life. You know, not going to give you too much of my sort of my personal story here, but negative coping strategies. You need to make sure when you're sliding down the mental health spectrum, because you're overworked, you're not sleeping, you may be not seeing your friends, you may be locked down and homeschooling. When you start to recognise those changes in your circumstance and those changes in your behaviour, you need to be avoiding negative coping strategies. Knock alcohol on the head. Make sure you're hydrated. These are silly little things, but they do make a difference when you add them all up. Yeah, get to bed on time, take some exercise, call friends, do things that give you satisfaction, whether that's sort of weeding a flower bed or washing a car or whatever it is. Anyway, but that's the mental health training that we had at work, which had a good effect on me. Just examples of why you ought to be doing these things. So advantages to the employer, right? It allows you to stand out, obviously, from your competitors. If you are, we're all in a war out there. We want the best people, and we want to keep hold of the best people. And I think that the pandemic has really sort of highlighted that. People, if we've been taking people for granted, I mean, I think the pandemic has made a lot of people sit up and say, we can't be taking our employees for granted any longer. We really need to be looking after them, because most companies, people are your number one asset. I mean, to take Beckett as an example, we're a people business. Probably a third of us are advisors and 2/3 of us are support staff. And if we don't have the best advisors and the best support staff, we're not going to be able to offer our service. And people are key in most organisations. So to get those people, you need to stand out from the firm down the road. You need to stand out from the other recruitment company in Market Harborough, whatever they're called, or the other financial advisor, up the road. So you need to be saying, in line with your employee value proposition, you need to be saying, we look after people. We care about your family. That's why we give you life cover. We care about your well-being. That's why we offer mental health awareness training. So it allows you to, just the nuts and bolts of it. We give you these benefits, and our competitors don't. So please come and work for us. But also it gives you a chance to say something about your company and who you are. This whole thing, it boosts engagement. I'm just going to presume everybody knows about employee engagement.
I'm sure they will, because we've covered lots on engagement previously. Yeah,
sure. Well, so benefits. It is a chance to engage with your staff. It is a chance to listen to their concerns, listen to what they want, give them something that they want, and talk to them about the thing that you've given them. So don't just put something in and say, there you go, there's that, and then never mention it again. You need to keep bringing it up. That becomes part of a conversation ongoing that you have with your staff. So you will benefit from a more productive workforce. So I think a lot of statistics now show that an engaged workforce with a high morale is more productive than one that's not engaged and does not have higher morale. The other thing, of course, it can reduce sickness and absence. So there I'm kind of referring to medical insurance, talked about an awful lot at the moment. I'm going to circle back around to that at the end. But it reduces the time that somebody is kind of waiting for the NHS to get them fixed. With income protection insurers, it's kind of the rehabilitation, so somebody's been off with cancer or they've been off with mental health. It's sort of liaising with their rehabilitation teams and trying to get somebody back into the workforce more quickly. Income protection insurers, they also have early intervention services. So if you have somebody who is looking, they've been off 2 or 3 weeks and you're thinking, this could be a long absence, contact the early intervention team. It's all they do. They contact your claimant, find out what's going on with them, and try and signpost them to help, to try and make sure that they don't end up becoming an absentee, to nip something in the bud. And with mental health, that is absolutely crucial. Income protection insurers have got an awful lot of statistics backing up the fact that if they can contact somebody in the first month that they are off with a mental health condition, they can usually return them to work before 6 months elapses. However, if you ring them at 6 months and say, our employee's been off 6 months now, we want to make a claim, there's probably very little that they can do for them at that stage, because by that stage, somebody's been sat in their house for 6 months by themselves. Have they been receiving any treatment? Likely they would have deteriorated, and it's much more difficult to sort of turn them around. Yes, so help with managing absence. So there was what I was just saying, but also in help with managing absence, if you sort of not outsource your absence management, but if you use, say, an income protection insurer as part of your managing absence policy, it puts a third party in between you and your employee, which might be a good thing. So an example, some people sometimes view income protection as tribunal insurance. So when they have somebody who is off with a subjective illness, it isn't the company that is making the decision on whether that person is fit to work or not. So I have a case at the moment. Let's get a bit of tea. I have a case at the moment with a client who has an income protection policy, and they also have a member of staff, a troublesome member of staff, who has received a diagnosis of ME, and so they are off. However, it is the income protection insurer that has written to the GP, written to the treating consultant, and it is them that has made the decision that this member of staff is actually fit to return to work. They're very well qualified to do that. They assess claims all the time, and they assess somebody against their occupation, against the symptoms that they're experiencing, and they talk to all the clinicians. And an income protection insurer, they've got a chief medical officer, so they're very, very well, qualified to do that. And in this particular case, that lady's bringing court action against the insurer. She's raised a complaint with the ombudsman, and she's been around all the solicitors, and there's going to be a bit of trouble. However, the company are fairly in the clear because they haven't made any of the decisions. They've outsourced it to their insurer, who's a qualified third party. So just another sort of angle to how benefits can help you as an employer. And lastly, in case you're sort of having an argument with anybody in finance as to why these benefits cost so much, let's always remember when we're having that conversation, they are offsettable against corporation tax. You can offset those against your profit to reduce your tax bill. I've done all that without my notes. I've likely forgotten something. I might just. Yeah,
sure.
I think I probably covered it.
I know when we were talking previously, we were talking about different sectors, and I know you were going to talk to us about what's popular by sector or particular age group.
Yes, yes, I was going to do that. Just bear with me a moment. I just wanted to check before I moved on from that bit that I haven't missed anything. No, think I remembered it. Yes, I'm back on Zoom. Yeah, so I'm kind of coming to that. It isn't as straightforward. On to the next bit. I was kind of going to say what I think you should be offering as a rule of thumb.
Okay. So this is across the board, all companies.
There are so many sectors, Eloise. I was kind of thinking, like, where do I start? And I have got a bit of benchmarking on manufacturing, just because I kind of thought, but there are so many sectors, and it's as I'll talk about on my next slide. Where's share screen? There it is. There's my notes. Right, sorry about that. I might just try and do it without the notes from now, because obviously I'm not that slick at going from screen to screen. So what should you offer? Well, as I was kind of just saying, that is, I've worked with so many different companies over the years, and they all do it a bit different. So really, you need to be benchmarking against your competitors, both locally and in your sector, because that's the pool that you are competing for talent in. I've in the past, I went to a builder in Ipswich who offered everybody private medical insurance, and when I went, I thought, well, this must be a really fancy high-end builder, because he's got 30 people that he's offering medical insurance to. And when I got there, I was sadly disappointed. I was just sat in a regular builder's yard with a regular builder, but it was his company, and he felt very strongly that everybody should have that cover. That's just the kind of guy that he was. And what you do find in some SME owner-managed businesses is that they feel very strongly about their staff, or they have very strong personal views as to what they should and shouldn't be doing, and they will do that, even if it's totally out of line with what is happening in their locality and sector. So I've never met another builder that offers medical insurance to anybody but himself or his family. But that guy was doing it to all staff. I also went to like a regional department store once, and he was offering income protection to everybody. You know, even like sort of part-time people that were just kind of working over the weekend, income protection to everybody. And I sort of said, do you realise that that's not really the done thing in retail? And he said no. And it turned out he got absolutely no idea what he'd got. And when he realised that he was kind of out of line with his competitors, we kind of realigned his benefits to more what people were doing in his locality. So I'm sure you know, you need to benchmark against competitors locally and in your sector. And how do you do that? Published research. Obviously, there's an awful lot of it around on the internet. So I tried to do something for this, and there's so much research. I'm not really sure that all of it is to be trusted. In your own sector, I think the much better benchmark is to look at your competitor down the road. You know, do they have their EVP on their website? You know, when they advertise for jobs, you know, what are they putting on the website? Ask HR contacts that you know. I mean, I should think that the HRHuddle is a really good source. You know, there's 90 of you signed up to this talk today. You know each other in this huddle. Ask around. What are other people doing? Look on job boards. Talk to recruitment consultants. So Eloise will have a good scoop on what people are doing in the East Midlands. She talks to people in all different sectors. Finger very much on the pulse. She will know. Likewise, employee benefits advisors. It's what we do all day. You know, we've got lots of clients. We will have clients in your locality and sector. We know what they're doing. Oh yes, this is quite a good tip, to use interviews, both for recruitment and exit interviews, to ask. I mean, when you're taking on somebody from arrival, what did you receive at your last place? You know, did they have this? Did they have that? That's just a good way to. And also on exit interviews, when somebody's leaving for another employer, I mean, you're probably all asking this anyway, but why are you going? You know, what sort of benefits are you going to? Just something to remember to cover. Actually, I'll go to the end of this. I'll go to the end of this slide, and then I have actually got some benchmarking for group risk for manufacturing from an insurer. So if you go to an employee benefits advisor like me, I would ask insurers. I would sort of say, you know, how many charities take medical insurance. So that's something I had to ask around the other week because I'm working with a charity at the moment. Insurers are universally bad at providing that sort of information. It's not really something that they can put the finger on very quickly. However, I was talking to an insurer the other day, and that they can do it now. So after this, perhaps we'll cut to a couple of PDFs that they sent me, which just sort of show how group risk policy products are popular in the manufacturing sector. Right, ask your staff. You may or may not think that's a good idea. You may just end up with a long shopping list of things that people would like. But you should do it. So talk to the staff, the employee in your organisation that you want to clone. You know, the one that you think every time you go out to recruit, I wish I could get another one of these. Try and sort of survey them and find out, what is it that you like about working for us? I mean, is it the salary? Is it the benefits that we offer? Is it the hours that you're working? Is it career progression? You know, everything that makes up your EVP. When you sit down to sort of write an EVP, or when you're working on yours, talk to your staff and find out what it is that they actually like. I was going to talk about age here. So age can be a little bit of a red herring, I feel. So people will sort of say, well, what do millennials want? You know, and I'm Generation X, and I guess a lot of you will be as well. I don't know you. And, Eloise, I'm thinking you're Generation X.
I am.
And yeah, it's always sort of kicked around that that on employee benefits, millennials want gym memberships and cash plans because, you know, they're young and trendy. However, I think that is a bit of a myth that is put around by Generation Xers, because maybe when we were younger, we wanted to go to the gym and, you know, we wanted young trendy stuff. Millennials are actually pretty sensible, in my experience. I mean, you only have to look at them. They don't drink, or they don't drink like Generation X. They save for houses when they're like, you know, just entering their 20s. They settle down early, and in my experience, they're very sensible, and they are interested in life cover and pensions, and they do look on group protection as a valuable benefit, and they do come to us as advisors and sort of say, how do I sign up? And I've got questions, you know. So I think it is a bit misleading to sort of say that that's just all that they are interested in. I don't think that they are. But obviously, the other problem that you have in a workforce, unless you are in a sector where everybody's 35, I mean, if that is the sector that you are in, you know, if everybody is sort of much younger, then yeah, you probably do want to look at cycle to work, and you do want to look at gym memberships, and you maybe want to sort of look at medical insurance with companies like Vitality, who have a range of benefits that are more important to the younger generation. However, if you're a 50-man employer and your workforce ranges from, you know, people who are coming up to retirement to sort of, you know, first and second jobbers who are beginning your career, it's difficult to tailor your benefit package to all of the factors that you know you might have, like, you know, 5 millennials, and then you've got a load of Generation Xers, and then you've got, you know, some of the baby boomers, you know, just leaving. It's just not possible. So I would just kind of say, don't think too much about the factors in your business, unless it's a huge factor that you need to sort of accommodate. Don't think too much about it if it's just you know, a normal makeup of staff. Align your benefits to who you are as an employer. So with your EVP, with the message that you're putting out there publicly, you know, Beckett's look after our staff, we pay for life cover. And why do we do that? Because the company doesn't get anything if one of us was to pass away. So why would they pay that premium? To look after the family, and that's part of your message. You know, if you are saying we're a very egalitarian employer, it's a very sort of flat structure here, then don't tier your benefits so that directors are on one level of benefit, managers are on another, and staff are on another. Try and put benefits in that are, you know, that are flatter. If you are saying that you are a green employer, then with your pension scheme, sign up to the Make My Money Matter campaign and tell your staff about it. So yeah, align it to your EVP. And then, of course, the other thing, practical considerations. You know, so it's all very well talking about EVPs and all the benefits that you can buy. I mean, can you afford them? That is a real consideration. Like my builder in Ipswich, who was paying for medical insurance, he could obviously afford it. He was out of line with every other builder that I've ever met. But he obviously thought that you know, it was his money and he could afford it. Maybe you're not in that. Maybe you're not in that boat. I would say, just on budget, dry up a bit. I would just say that on budget, employee benefits vary hugely in budget. So life cover, for example, yeah, I mean, if you buy life cover at 4 times salary, if you've got an older workforce, that might be expensive. But don't sort of say, oh, we can't afford it, so we're not going to bother. I mean, you can put life cover in at a flat benefit of 25,000 or 50,000, and then it's cheap as chips. So it is better to put a low level of cover in than no level of cover, because then you can point to it and say, we've done something. You know, we can't afford this, but we put this in. So we do have a life cover policy. You know, we can't afford medical insurance up here, but we can put a cash plan in, which is like entry level medical insurance. And we put a basic level of cover in. Ultimately, the majority of staff, let's face it, they don't know what they've got anyway. So if you say you've got life cover, they go, oh, I've got life cover. You know, they probably won't know all the details. So, so a low level of cover better than no level of cover, and you can tailor benefits to suit most budgets. The other thing, can you handle the admin and the promotion that comes with employee benefits? So everything I've spoken about so far, you might think, well, that's great if I was like in an HR team of 4 and I was just doing the benefits and the EVP thing, but you know, I'm also doing some finance, some company secretary, you know, I'm only wearing this HR hat part-time. So, you know, that's quite a lot for me to take on. So yeah, practical considerations. So I think now I'm just going to try and go back to that that PDF that I have had. It sort of shows how group risk products are popular in the manufacturing sector, and I can get this on other sectors. So but there are so many sectors. So if you think, well, actually, Gareth, that looks really interesting, I'll be interested in that for our sector. So this is a report that I've had from Unum. This is a report that I've had from Unum, and it's taking an age to open. I said, can you give me some benchmarking for a manufacturing company with 100 employees in the East Midlands? And this is what they've sent me across. And I'd have to say, this is actually really good for an insurer, because normally when I ask for this, I just get something that is completely not usable. So if you're in manufacturing, you're going to think, oh yeah, this is why I tuned in. If you're not, then contact me and I can get you the same for. There are so many sectors. So in this peer group, Unum, who are a large group protection insurer, on life they insure 394 such companies, and reported employers in that peer group is nearly 7,000. So that is quite a low penetration for Unum. Market penetration nearly 70%, which I think is about right. Life cover is probably the most common benefit, sort of after pensions. Not overly expensive. It's kind of expected at most employers. So that shows the market penetration. This shows some of the factors about how the benefits are arranged. So here they've got cover C-Sage. So the majority are running it to 70 or to state pension age. There's a bit of an anomaly here. So this is probably like old policies that have not been reviewed. They run to 65, which would actually now be out of line with age discrimination legislation. If I got hold of those, I'd be saying you need to change that from 65 to state pension age, so it just tracks, because your obligation as an employer is to cover people at least until they reach state pension age. If you've got a cut-off below state pension age, you need to be able to objectively justify why you're not covering somebody up to state pension age. And then, yeah, quite a lot got it to 70. Benefit type, the vast majority of death in service policies are a multiple of salary. Some of them are flat amounts. As I was saying before, if you do a flat amount, so I've got quite a few sort of production sort of companies where it's they just pay it's a very low salary, and they put in 25,000 as a flat benefit. So in the event of a death, it's 25,000, and that's a good benefit to put in. The multiple, the majority are still 4, 3, And with the ones that are on a flat benefit, they've got quite a lot there around the 100,000 mark. So that's the sort of benchmarking that you can get from Unum now, quite a recent thing. And now I found that out, to be honest, I'm going to be asking for it for a load more of my clients. But
so Gareth, what benefits do you think businesses should be offering at the moment? You know, kind of what's trending at the moment?
Trending, yeah. So just going to go back to my notes a moment. Sorry, Annalise. So trending, and I had some stats on this, so I might just flick back to me because I've got a group risk insurances are trending. So that is life and income protection, certainly pre-pandemic. So I would kind of say, obviously, this thing, the pandemic has turned everything on its head. So at the end of 2019, group protection policies, life and income protection, they were trending. So the group income protection market, that saw a 7%. That saw, sorry about that. I thought I put my phone on silent. Obviously, don't know how to do that. So yeah, group income protection saw a 7% 7% growth. And why did that happen? I should think it's because group income protection was it always used to run. It would pay like 75% of salary until cease age, which like potentially is a long claim and it can be quite an expensive cover. But then a lot of new policies have been put in on income protection with a limited payment term. So it will pay for like 2 years or 5 years or 1 year. And the ones that are putting it in for 1 year, as I say, they're kind of using it for like that tribunal insurance sort of thing. So they're putting it in so that if they have an absence, a long absence, it's the insurer who is making the assessment of whether the person can work or not, and not the company. So yeah, and putting it in on a limited payment term is much, much cheaper than putting it in to retirement. So people would always think income protection, that's really expensive. That's too much for us. But then it is being sold on what, if you do it on a 5-year term, it's half the price of paying to retirement. So, you know, 50% a good discount, isn't it? And I had one that I'm doing at the moment, that's on a 5-year term, and the company are looking to go to a 2-year term. And they're looking at a 30% saving on that as well. So it's very, very affordable if you do it on a limited payment term. So income protection, that's 7% market growth, 5% market growth in group life. And I actually think that's even more impressive because group life was starting from a much higher base. Group life, so many companies have group life that grew by 5%. With actually, like, it was a massive amount of people that went on cover for the first time. And the reason that is happening was because pre-pandemic, we were looking at sort of very, very low levels of unemployment, and companies were saying, we need to be doing something with our benefits. We need to be improving things. What can we do? And when they were reviewing their benefits, if they hadn't got life, they were putting life in. And then it goes back to this message. We care about you, we care about your family, and we're putting this in. The other thing that's sort of led to a growth in group risk sales is probably the additional services that you get with them. So you're not just buying that financial protection. AIG, to name a name, on life cover, they're now given access to a digital GP service. Now, digital GP services are very, very well received, particularly at the moment. So anybody that has life cover with AIG has a digital GP, which is an app on your phone where you can consult with a registered GP 24/7, and you can usually get an appointment within like sort of 3 or 4 hours. So you can get that with a life policy. So when I've been talking to companies who are saying we need to be doing more with benefits, I've been saying, well, we don't have life at the moment, or if we do have life, maybe we should look at putting that with AIG, because then you would get this digital GP service. And, you know, everybody's expecting not to die, but people are thinking, well, I might need to see the GP. And
let's face it, nobody can see a GP at the moment, understandably.
Yeah, well, I mean, something else. I'm going completely off script now. maybe that's better. Digital GP services, they are offered. They're offered by AIG on all policies. With Canada Life, Unum, and Aviva, they're offered on income protection. Medical insurers have them in their core offering, and a lot of cash plan providers now have them as added extras. And I mean, you all really want to get a digital GP. I mean, that is really going to sort of help with sickness and absence, and helping people to access that treatment early. A really good stat that you'll all take away from this. Bupa pre-pandemic, on their digital GP service, they were doing 300 consultations a day, and now they're doing 5,000 digital GP services consultations a day. So that is a massive explosion in usage, which I'm told is being replicated on other provider services. So, and a high proportion of people that are seeing digital GPs are men, which is reassuring. I've used mine 3 times since the pandemic, and I'm never normally ill. But I think it's just that convenience. You've got whatever you've got, and I won't overshare again. You've got whatever you've got, and you can just sort of hop online, get a digital GP, talk to the GP for sort of 20 minutes or so, and they can also prescribe you medication, which is just amazing. With some services, that medication you can arrange for delivery. With mine, I just got the prescription on my app. I took it up to the chemist, and I got what I needed. So,
I mean, that's a great benefit to be able to offer people. What else is would you be recommending?
So I would sort of say that pre-pandemic, group risk sales, as I was saying, that they grew. The one that we are all expecting. So with the pandemic, it's so funny by a sector what's happened. So the manufacturing companies that we were talking to, they were all looking at putting cash plans in. So we had a lot of cash plan work in the pipeline, and then that all went away in sort of March, April, May. And interestingly, it is now coming back. So I think that everybody, let's face it, it's sort of turned everything upside down, hasn't it? So a lot of those manufacturing companies and transport companies, they were sort of saying, just stick everything on ice. We're not doing anything because we don't know about, we don't know about orders, we don't know about furlough, we don't know about anything. But now they are recontacting us, we are recontacting them, and we're working on those cases again. And what is driving that is concerns about the NHS. So at the start of the pandemic, so March last year, NHS waiting lists were 4.2 million, and in December they were reported to be 10 million, and quickly escalating. And obviously there was an awful lot of coverage in the press about NHS trusts having to cancel cancer operations, and the stat always gets thrown around about how long you have to wait for a hip, and they sort of said that hips were going to sort of the wait time for a hip had increased 100-fold. So if you need one, you're unlikely to get that in your lifetime. So that sort of thing was driving a lot of medical insurance queries as well. So medical insurance was the product that we were the most worried about, because the NHS requisitioned private hospitals during the pandemic, and so a lot of that capacity privately has been lost. However, I think that the concerns over the NHS kind of outweigh that, and medical insurance is being looked on as a very valuable benefit. We haven't really lost any schemes. The schemes that we do manage, we're seeing an uptake in membership, where people who are seeing these stories about the NHS are now going to HR saying, "Where's that form? I refused to cover 2 years ago, but can I go on cover now, and how do I do it?" So we are seeing memberships increasing on the schemes that we manage. And we are also, us anecdotally, but across the industry, we are seeing that there's a lot of virgin quotes being done. Companies who are new to market, and I'm working on a couple of big ones at the moment where I kind of think, I can't believe you didn't have a scheme. But they're coming to us now and saying, we're really worried about the NHS. We really think that this is the benefit we need to be offering staff. Should have done it years ago. And they're now coming to us for quotes. So as we come out of COVID, I think there's going to be a boom in medical insurance sales and also cash plan, because medical insurance isn't for everybody. It is a premium product. There's only 3 million on cover in the UK. But for those that are not putting in medical insurance, they will be interested in cash plans, because also with a cash plan, you're going to get the additional services that have been so valuable in COVID. So with a cash plan, you'll get an employee assistance program, for free with access to counselling. So you'll get that digital GP service. You'll get that with a cash plan,
and that's invaluable at the moment, isn't it, for employees?
Yeah, exactly. So that's kind of what's trending.
Okay, fabulous. So I know you said you were going to share with us some of your kind of top tips for how to avoid some of the pitfalls of employee benefits, and I think that's probably a big interest for people.
Yeah, I can't believe how long I've been talking. I'm really sorry, Eloise. I told you that might happen. So I've got a few things that I always say to HR people when I go in there. So right, life cover. Just a couple of quick things. So life cover. All life cover policies have a trust. So the money, in the event of a claim, that money, it doesn't go to the company, it goes to a trust, and then it's paid out. Tax-free. And a lot of times I start talking to an employer, they say, "Oh, Gareth, I don't think we've got a trust. Keep talking. We haven't got a. You've got a trust. You've definitely got a trust. You've all got a trust." Now that trust can either be a company trust, where the company is the trustee. You have your own trust, which is a legal document. I bet you don't know where it is if you've got one. Or you can use an insurer's master trust. You can use, and if you are on a standalone trust, use an insurer's master trust. And the reason for that, it makes the claim so much quicker. So maybe a bit of a dry subject, but use their trust. That way it will stay up to date. If you have your own trust, a lot of the time I'll see an employer and they set the scheme up 15 years ago, and since then the company has changed name. The people who were listed as trustees have all left and retired, and it's just not up to date with current legislation. So use an insurer's master trust. There's nothing to fear with master trusts. The second top tip on life cover: if your life cover is linked to your pension scheme, really quickly contact your advisor or me, and we'll unlink it. You do not want a life scheme attached to a pension scheme. Often that's just how they were done, because life schemes are often sold by pension advisors, and when you signed up to the pension, you got the life, and that's how it worked. However, in the fine print of your contract, it will say you get the life cover if you sign up to the pension scheme at your first opportunity to do so. So if you join and you say, "Oh, no, I don't want to join the pension scheme, thanks. I need all my contributions, so I won't do that." You can't then work for that employer for 2 years, get a diagnosis of cancer, join the pension scheme, and then receive life cover. That's a discretionary or late entrant. So really, if you have it linked to your pension scheme, unlink it. And also, what's the sense in doing it? I mean, do you only care about the families of people who joined your pension scheme? No. So, unlink it. It doesn't make any sense. It doesn't save you any money. And in the event of a claim, it could leave you with an uninsured liability. So do that quickly. The other thing is, if you have a qualifying period on a life or an income protection scheme, if somebody gets that benefit after 6 months service, the point at which they are eligible to join the scheme, they must be actively at work. So if you say, on our life scheme, you get life cover at 6 months, is that person actively at work at 6 months? Because if they're not, then they don't get the cover. They get the cover when they come back to work. So for anybody with like a long qualifying, somebody has to be here 2 years, potentially they don't automatically get that benefit. That's what I'm trying to say. So qualifying periods, again, they can potentially leave you with like an uninsured liability, depending on what it says in your contract of employment, and they don't save you any money, and they just make the whole thing really complicated. So get rid of that. Income protection, notify of a claim early. If you have an absentee, tell your insurer as soon as possible, because they have early intervention teams that will contact that employee and signpost them to treatment. So they can potentially avert an absence. Don't contact me at 6 months and say, this person's been off for 6 months, can we have a claim form, please? I've had quite a few of those recently. The insurer's got to write to their GP, their treating consultant, they've got to get all the clinical notes, make their decision, and that can take time. So your employee is not getting paid unless you're going to continue paying. They're not getting paid while that claim is being assessed. So notify early. It just makes the claims process, everything can be, if it is a genuine absence, you're going to get that decision early and everything's going to be set to pay the moment that the claim goes into payment. If not, somebody's going to be out of pocket. So do that. The other thing
Gareth,
Yep.
sorry, just before you go on to the next top tip, we've just got a quick question for you. Back on the life assurance policy being linked to a pension, somebody's asked, Joe's asked, how do you know if your life policy, how do you know if your life assurance policy is linked to a pension?
On your policy schedule,
Okay.
there will be a bit that says eligibility, which is who is covered, and that will say something like, what you want it to say is all employees of the employer. That's what you want it to say. You don't want it to say all employees of the employer after 6 months or after 1 year. You don't want it to say all pension scheme members.
Okay.
So,
And can you write a new trust if you can't find the original one?
yes.
Brilliant. Thank you.
Yeah. Yeah. If you don't know where your document is, then I'm not saying it's a massive problem, but I mean it's probably something that you want to sort out. So so yes, you can like actually at any point you can contact your insurer. All insurers offer master trust. You can contact your insurer and say, can we use your master trust? We no longer want to use ours any longer. That's easy to do.
Okay, thank you.
Well, depending on your insurer, actually, sorry, some insurers can be funny about that, but that's something for your advisor to worry about. Income protection. I was going to say, if you've got an income protection policy, you might think, well, this is a bit expensive. As I said earlier, income protection that pays until somebody's retirement age, that's a big premium because potentially an insurer could be paying for somebody who goes off at 45 until they reach 66 or 67. That's a 20-year claim. So it's a very expensive premium. These days, I think we all accept that we're probably not going to stay with an employer until we retire. Sad, but that is probably what's going to happen. And so why insure somebody's income until they retire? If they're not going to work for you until they retire. So I would say look at going onto a limited payment. So a 5 years is plenty. If somebody has road traffic accident or a cancer or something like that, 5 years would cover it. You're doing plenty if you're doing 5 years. There's not many claims that go over that, so you'd be unlucky. So yeah, maybe look at going on to a 5-year term. There has been a big shift in policies. All the new policies coming to market are written on a limited term, and a lot of the ones that are being rebroked are steadily changing. And then a couple more tips. I've been talking no end, haven't I? So if you've got a medical insurance scheme, keep your membership clean. That's the only tip I'm going to give you on that. And by that, I mean, in the terms of your policy, it says that, that the insurer expects that the company is at least funding the premium for the main member, for the employee. They don't expect you to pay for people's wives and children, but they do expect you to pay for the member. So if you are offering the benefit and letting members pay for it themselves, that person is potentially not covered. So and lots of schemes got somebody's brother-in-law on, or they've got this guy used to work here, but he's a friend of and we let him stay on, and he just gives us the 500 quid every year, and nobody says anything. But if the insurer finds out that member's not paying their premium, they're not covered. So you've not been doing them a favour by letting them stay on your scheme, because right. if the insurer should find out, they could potentially not pay that claim, and it could be a big claim. So keep your membership clean. With children, insurers will now allow you to keep children on until all sorts of ages. But if somebody's child has a really expensive, and when I say child, I mean like 26-year-old, 27-year-old, if they have a really expensive claim, it's going to put the premium up for your members. So the people that actually work for you are going to be, paying higher premiums or higher P11D benefit because of somebody that doesn't work at the company. So do try and keep your membership clean, limit it to employees.
Okay, fabulous.
And then the last top tip I'm going to give you, and then I am going to shut up, is salary sacrifice. If you're not doing salary sacrifice, why not? Because anybody that has salary sacrifice explained to them should realise that it is a no-brainer. It is just a tax-efficient way of making a pension contribution. In fact, I said salary sacrifice, I should have said salary exchange, because the idea that the word sacrifice, I don't want to sacrifice salary, that's my salary, you're just exchanging it. You're exchanging a portion of your salary for the same amount as a pension contribution. And because you are doing that, so you say, don't pay me that £1,000, and then you have a legal agreement, and the employer pays the £1,000 in. And by doing that, it all goes over as an employer contribution, and there is no national insurance on that contribution. So 13.8% is saved on the value of the contribution. And if the employer is prepared to put that saving in as well, then you've just increased everybody's pension contributions by 13.8, and it's not cost you anything.
Fabulous.
It can be a bit tricky, salary sacrifice exchange, but once you get your head around it, everybody would appreciate that and want to sign up for it.
Brilliant. I've got just a couple of questions, Gareth, if that's okay. So back to the benchmarking that you spoke about. Who was your source for that benchmarking? Was a question asked.
That was Unum. Yeah,
Lovely.
That was Unum. We're having a sort of a team call on this. Benchmarking comes up so often, and it's so difficult to get decent data. And then it was very recently, actually, that Unum sent that benchmarking across, and it's the first time I've actually seen benchmarking come across in a usable format.
Fabulous. And is that something that people would be able to go to them directly with, or would they need to go through you or their advisors?
Well, I could say, no, you need to speak to me. But no, I don't think you can go to your advisor. I'm probably giving your advisors a bit of a steer on this, because I didn't realise that Unum did this. I think it is a fairly recent thing, because I've never seen this before. So you can go to your advisor and just sort of say, look, I saw this thing with Beckett's the other day. Unum are doing these reports. Can you get me one? Yeah. Obviously,
really useful.
Yeah.
Fabulous. The other question we had in was a company saying that they offer £250 to claim back on eye tests and prescribed glasses every 2 years as part of their policy. But they've got an employee who has diabetes and asked if she can claim every year. They've asked, do they need to be mindful to her medical condition, or is it up to them as a company to reject her request and stick to the policy?
Company discretion. I think if I was 250 per 2 years, was that? That's really that's really generous. That is really, really generous. So I would think they're doing quite a lot there. If they are just a really generous employer and they're that way inclined, then they may sort of say, well, in view of your diabetes, we'll make a special case for you. But I think on the official guidelines, no special case is made. So I think that's down to them.
Okay, great.
They're not. I'm fairly certain they're not obligated to.
Okay, wonderful. So thank you, Gareth. That was a really informative session. If anybody doesn't have any other questions, then I will just thank everybody for joining us. I hope you've enjoyed this afternoon.